Welcome to Classic Value Investors. My name is Mariusz Konieczny, and today I'm speaking with Rick Rule, the chairman of Sprott US Holdings. Uh, Good morning, Rick. How are you?
Fine, Mariusz. Thank you for the opportunity.
Rick, you have been in the natural resource business for many, many years. And since we spoke last time, which was several months ago, lots of things have happened, including the heavy sell-off in the price of gold and silver in April, and also how I would say it, a meltdown in the natural resource stocks. Uh, how how does the market sentiment that we have in the sector compare to the market sentiments that you saw during your investing career?
That's a really interesting question, and I think it's all over the page. One of the things that you're finding that's very useful to value investors, that's consistent with market bottoms, is professional capitulation. You're seeing high quality investors and high quality managers and professionals depressed enough that they're leaving the space. You saw people who were taking some career risks in exploration, performance based people looking for salary based compensation, which is to say that their expectations of the future have been shaped by their experience in the immediate past, and they're forgetting the longer term history of the business, which is again a very, very, very bullish sign. Professional capitulation was what was, of course, flagged by Ben Graham as being indicative of a sector bottom in any particular market. On the other hand, you are seeing increasing interest in the sector, particularly from private equity investors and sovereign wealth funds. And so, one of the things that's happening is that at the project level, not necessarily at the equity level, but at the project level, there's an undertone of support. So the capitulation that one would have hoped for, the total capitulation that one would have hoped uh, for the interim time frame has been averted. I think because of the interest of people like the Chinese sovereign wealth fund and the big private equity players like Apollo. So it's mixed. Certainly, the valuations, the enterprise value of companies relative to the net present values of the free cash flows that can be generated from their deposits at these commodity prices are very attractive and very compelling.
What I find interesting in my business is that I have lost a lot of clients uh, during the early part of the year. But the clients that are approaching me today are extremely sophisticated, and some of them really shock me because it's in my blood personally to be adding money to some of the positions that I have during these times, but I don't necessarily see it happening from my clients, except the ones that came on board over the last 2 months or so. Um, is this something you guys are seeing in your firm too, or this is just my particular situation?
No, I think that's maybe more your participation. We have been very, very, very active in terms of outreach, giving interviews to lots of media sources, speaking in lots of conferences. And interestingly, our client flow and asset flow has been positive for 12 months. Yes, we've had, of course, existing investors, particularly those who came in the 2007, 8, 9, 10 timeframe, leave the sector. But we have found very, very, very strong underlying investment support at Sprott. Certainly, I would suggest that one thing that's concurrent with every market cycle is that the investors who have the courage and the intelligence to enter the market in periods like these are of higher quality than the ones who enter the market at the top, more cerebral, less emotional, generally richer. And of course, history teaches us that they'll all also have a they'll have a better experience in the market too. It's a truism that you do better when you buy at the bottom than buy at the top. But the outflow of customers that you speak of, we experienced in 2000, late 2011 through 2012. For us at Sprott, the 2013 has been marked by relative success, both in terms of stemming the outflow of assets and increasing the inflow of assets. By assets, I mean clients and client assets under management.
Very interesting. Rick, you famously said that the entire research sector is valueless, which means that I assume that this means that the majority of mining companies are simply worth nothing. But when you look at a specific company, we don't have to discuss specific names, but when you look at a specific company, what do you mean by this company being worth zero? Does it mean they have no assets? Could you specify this?
Yeah, I want to recharacterize what you said.
Okay.
I didn't mean to say that the entire mining or resource industry was valueless. What I meant to say was that the junior sector, taken as a whole, is valueless. If you look at the Toronto Stock Exchange Venture Board and you add in the lower half by way of market cap, or lower two-thirds by way of market cap of the ASX and AIM, in other words, you formed one single company out of the junior Explorco industry on a global basis. That company would burn more cash than it generates. In other words, the industry burns more cash than it generates every single year. That belies the fact that the top decile among those, say, 1,000 companies generates so much performance that it adds respectability and, in fact, luster to the entire sector. So what I'm saying is not to avoid the sector, but rather focus on stock selection, not sector participation. It's very, very, very important that people understand that differentiation.
And when you mean a junior mining sector, in if you put it into one company, you said a company name Explorco. So do you mean when you say junior mining sector, do you mean mainly exploration companies, or do you also include some small producers?
I would probably, for ease, just lump in the entire exploration and the entire development sector all into one. The junior producers are a different discussion with regards to valuation and risk. Certainly, they are lower risk. They are at lower risk of absolute failure than the Explorcos, and certainly it's easier to analyze them because you can look at the resource base, you can schedule out their free cash flow, you can schedule out their costs, and determine with some reasonable degree of certainty how they would perform at various commodity prices. Uh, Forecasting exploration success with the junior Explorcos is much, much, much more difficult. So I think I'd confine my remarks to the publicly listed junior explorers and pre-production sector.
I see. I remember one time you had an interview with someone else, and you mentioned that because of the market sentiment as we see it now, you as an investor have the opportunity to buy into uh, the development companies at prices that you are usually not allowed to enter them. Could you talk about this a little bit more?
Yeah, absolutely. Um, the pre-production sector was extremely hot in the 2008, 9, 10 timeframe. And companies were being valued at least twice the net asset values established in their bankable feasibility studies. It's, you know, I mean, if you talk about a depleting asset, valuing it at 2 times NAV implies either that the asset's going to grow fairly substantially or that the commodity price is going to go up. You have to amortize that premium in one of two assumptions, either that the asset grows or that the commodity price goes higher and hence the margins grow. Uh, since the collapse in commodities-related equities beginning in 2011, those values have fallen really, really, really dramatically. And it is now possible to look at a universe of probably 40 stocks on a global basis where the enterprise value, that is the market caps less working capital, are selling at a substantial discount, even adding back the front-end capital expenditures necessary to build out the projects. In other words, adding the sum of enterprise value and construction capital expenditures, it's possible to look at probably 40 companies where the net asset values assigned to the projects in the feasibility study exceeds the combination of enterprise value plus front-end capital cost. It's important to note that this conforms fairly closely with Ben Graham's margin of safety because you've double counted, in this case, the front-end capital cost. And a situation where you get that range of valuations and you combine it with fairly high internal rates of return, that is pre-tax internal rates of return in the mid-20s, payback periods of 3 years or less, this sort of pricing is indicative of a market where there is absolutely no positive sentiment with regards to the sector. There's no optionality built into those assessments. They're very, very, very reasonable valuations. We at Sprott are of the belief that commodity prices in both a real and a nominal sense are going higher. And so we think that the net asset values will respond to higher commodity prices because these producers are leveraged to higher commodity prices. And we think as the commodity prices trend higher, that the sector will return to favor. So our suspicion is that a value investor who gets himself or herself positioned in the next 18 months will benefit 3 ways. They'll be buying assets that at current commodity prices are selling at substantial discounts to what they're worth. You benefit because the commodity price quotes in both a real and a nominal sense will be higher and take the valuations higher. And you'll benefit because the whole industry will reprice similarly to the way that it repriced in the 2002 to 2006 timeframe, or earlier than that in the 1994 to 1996 timeframe. Call it a triple play if you want. We think it's very attractive. The caveat that I have to add to that is that the investor or the investor's advisor has to look at the preliminary economic assessment or the bankable feasibility study and has to look at the parameters that went in establishing the net asset value to determine whether or not they think that the parameters that establish the valuations are real. You know the old phrase, garbage in, garbage out. You need to make sure from your point of view, or your advisor needs to make sure, that the valuations established in those third-party documents are real valuations.
I see. I recently spoke with the CEO of one of the companies that I own, and we were discussing that the Mexican government recently introduced a new royalty fees on the precious metals mining companies in Mexico. And
Yes.
I thought to myself, wow, what a great timing for the government to be doing this when both gold and silver prices have been getting crushed over the last 2 years. So why not tax them more since they are swimming in cash? What are your thoughts on this new rule?
Well, I think actually their timing, I think actually this is something that they probably wanted to do in 2008, 2009, 2010. But being governments and fairly inefficient, rather than doing it at a market top when the industry could have stood it, They're doing it in the market bottom when the industry can't take it very well. A 7.5% royalty equates to, if you add back taxes and everything else, the government probably taking more than 50% of the economic value of mineral production in Mexico without putting up a dime. Um, my suspicion is that this is going to greatly constrain mineral exploration and development in Mexico, given the industry's fairly high cost of capital. And I think it will ultimately result, and when I say ultimately, I mean 4 years out, 5 years out, it will ultimately result in a lower gross government take because they'll get a higher margin but on much, much, much less economic activity than they otherwise would have got. I think it's the industry's fault because the industry in good markets was reporting the economic value of deposits by doing things like reporting cash costs that didn't include the acquisition cost of the material or the capitalized discovery cost of the material. The industry was trying to lead the investment community into believing that mining was a better business than it actually was. The governments and various social groups read all that same material and decided that the industry could support a much higher level of taxation than the industry actually can. It's interesting that Scotiabank recently released a study which talks about the total cost of gold production on a global basis, including capitalized general and administrative expenses, and importantly, recapturing the acquisition or exploration costs that have been written off by the industry over the last 10 years. Scotiabank anticipates that it costs the industry over $1,700 to make an ounce of gold. If you make an ounce of gold for $1,700 and you sell an ounce of gold for $1,300, the business obviously isn't earning its cost of capital, and there really isn't any room to increase the social take. But the governments believed what the industry did as opposed to what the industry accomplished. So I think that's very, very, very problematic in the intermediate term.
I have one last question, and this is a question from a reader of my blog. And the person says, ask Rick Rule if he thinks that one can buy a basket of miners here at these levels and just step away for a few years, or if one needs to do a lot of due diligence still.
One needs to do a lot of due diligence, and one needs to stay on top of them. If your reader is an investor and not a speculator, your reader could probably follow one of two strategies. That is to buy 10 very, very large cap, ultra large cap natural resource companies, and give the portfolio 5 years, give it a change of cycle to perform. One could also consider buying Petroleum and Resources, which is a closed-end fund on the New York Stock Exchange that effectively does that and sells at a discount to NAV, and let the portfolio managers at Petroleum and Resources, the symbol is PEO, implement that same strategy for them. Normally, investors who are concerned with alpha are investors that subscribe to services like yours and newsletters. They're looking for an edge that isn't obtained by investors. And that type of person, a more speculatively oriented person, is probably going to look for alpha as opposed to beta. And seeking alpha requires a lot more work than trying to participate in the beta of the market. So it'll really be based on the orientation of the investor that asks the question. Sorry for the long-winded answer.
No.
The question seemed to require it.
Very helpful. I don't have any more questions. Do you have anything that you would like to add that we didn't discuss, whether it's about the junior mining sector or the gold market, silver market in general?
Well, I think the thing that I'd like to leave your listeners and readers with is simply the fact that this is an extraordinarily cyclical and extraordinarily volatile market. We are 2 or 3 years into what is either a 4 or 5 year cycle, meaning that we are a year or two away from recovery. People who have been in the industry have now experienced the pain, and I think they may as well hang around for the gain. And I think what's important to note is that the recovery from these bear markets in the junior resource sector in particular is so incredibly violent that it's really worth participating in. The portfolio that one can obtain from a carefully chosen basket of high quality juniors, that is the top 10, the top decile of junior issuers, is unlike the response that I think is available from any other single sector in investing that I know of. Uh, so for people who have an 18 to 24-month outlook and can tolerate real risk in case I'm wrong in terms of timing, and are willing to put some time and effort in addition to treasure uh, into the pursuit of alpha, I think will find themselves rewarded in a way that they can't realize in any other sector in financial markets.
Well, thank you very much, Rick, for your time and joining me for this interview today.
A pleasure. Thanks for the opportunity.